don't overplay the dollar's decline in 2021. Expect some weakness, but little to point to a sudden collapse. Many observers are approaching an extremely low 2021 outlook for the dollar. This view is sometimes associated with an increased risk appetite, the end of a strong dollar cycle, or the twin deficit collapse. Given the random walking nature of exchange rates, predicting the dollar's 2021 outlook can be an act of arrogance. However, the dollar may really drop this year, but an extremely negative narrative is not justified. Many arguments are not valid for a future crash. First, the dollar is already falling sharply. In 2020, the dollar index, DXY, fell around 13% from its March high and around 7% for the year. DXY is a proxy for dollar trading against major currency pairs. 3/4 is derived from the euro or euro-related currencies. However, these currencies make up roughly 1/4 of US trade. The dollar's March peak was disrupted by financial market panic. More than half of US trade is in emerging markets. China and Mexico make up half of that. The other Asian countries at 1/5 or more. The Federal Reserve's trade-weighted indices are showing less dramatic movements than the DXY. The dollar fell about 2.5% in 2020, up about 5.5% against developed economies and 0.5% against emerging markets. Second, as economies recover from COVID-19 and a vaccine is deployed, risk appetite will strongly favor non-dollar currencies. This reasonable view needs to be corrected. America's financial support and growth potential is higher than Europe or Japan. Faster US growth generally supports the dollar. Vaccine distribution may not be uniform. Economic scaring can hinder healing. Even in a risky environment, there will be bouts of volatility and risk aversion. Third, the relatively easier US currency conditions could trigger a dollar sell. Changing interest rate differentials and relative monetary policy stances are the main drivers of the exchange rate. However, developed economy central banks have all reduced their interest rates to zero or the effective lower limit and are pursuing quantitative easing. Speed differences are compressed. With central banks pending, this reality is unlikely to change anytime soon. But even assuming that the dollar depreciates significantly, Europe and Japan will fear deflation and exports will lose. The European Central Bank and the Bank of Japan will seek further compromise. Fourth, the strong dollar cycle is coming to an end. The chart below points out 3 periods of major dollar movements. The dollar fell in the late 1970s as inflation soared amid losing confidence in US economic policy. In the early 1980s, the dollar rose after Paul Volcker tightened monetary policy to contain inflation. This move was pushed further by expansionary fiscal policy and the dollar recovering from lows in the late 1970s. Before and after the global financial crisis, the dollar fell as the US continued the monetary settlement earlier and more aggressively than Europe and others. The chart also shows dollar cycles lasting 10 years or less. Indeed, the real trade weight dollar has been on the rise for the past 8 years and is now on the strong side. But the dollar is nowhere near the peaks associated with major fluctuations in the past. It is still well below the peak of the 1985 Plaza settlement period and well above its 2002 peak and post-major recession lows after the euro started to decline in opening. Fifth, the US twin deficits will tank the dollar. With the advent of fracking, the US current account deficit has remained at around 2% of gross domestic product over the past decade, although the COVID-19 outbreak will increase this. The US will face huge fiscal deficits to overcome the crisis, but America has the deepest and most liquid capital markets in the world. It exports US Treasuries, the world's leading secure asset. Interest rates have plummeted, and the Fed will continue to buy most of the US debt issues. If demand decreases, small yield increases will pull back inputs. Twin deficits could become a problem in the future, but meanwhile, America can finance them well. Sixth, emerging market currencies could rise sharply with strong risk appetite. The outlook for emerging market currencies points to a modest appreciation. The renminbi is a good candidate for more appreciation. China's current account surplus is growing sharply, thanks to lower oil prices, a collapse in tourism outflows, and strong personal protective equipment and home business exports. The capital account was bolstered by inflows attributed to relatively high government bond yields and the inclusion of renminbi stocks and bonds in global emerging market indices. But the authorities can be cautious about bigger gains and carefully allow more exits. The Mexican peso seems to continue to be supported by relatively high interest rates and the country's conservative macro stance. Asian currencies may experience upward pressures, but will try to contain them. In addition, the trade-weighted index of the dollar may drop in 2021, but there does not appear to be a possibility of major depreciation or collapse. Of course, never ignore the random walk.